James, great to see you again.
Good to see you, Pat. Hope you're having a good summer.
I am indeed. But that's the point of our call today, because here we are halfway through the year. 6 months have been very volatile for a lot of the markets out there. How have we done overall?
Well, year to date, it's been a pretty good year. Canadian markets are up about 10%. International markets are up even higher, about 13%. US markets haven't done quite as well. They're up about 6% in US dollar terms. But when you take into account the fact that the US dollar has actually declined a bit throughout the course of the year, when you translate that to Canadian dollar terms, US markets are basically flat. So the equity markets overall, when you look at those three regions, it's pretty strong. And I would even extend that look back a full year. So if you take the 1 year ending June instead of just year to date, the numbers are quite strong. Canada's up over 26%. And that really stuck out to me when I was doing our second quarter commentary. Other markets are up strong as well. Both the US and international markets are up 15% or more. So when you look at that for 1 year returns, those are incredibly strong numbers.
Yeah, over the longer period of time, it plays out, doesn't it, to stay in the marketplace despite all that volatility. But the focus right
Right.
now is earnings. We're getting a lot of the high tech earnings coming in. I want to talk, if we just could, because we've done it in the past, about tariffs. Are they kind of by the board now, or at least peak tariffs? Are they done?
Well, I think a lot of the major anxiety is out of the way. But we've got, if we talk more broadly about, let's call it the Trump effect, that's still alive and well. So at any given point in time, he could go off on something, whether it's tariffs or something completely unrelated. He can move markets, and his, let's call it unconventional ways, are things that markets are not used to, and they're not sure how to analyze it, and they panic. And that's why you get the violent moves that we've seen so far this year in both directions. I mean, we've got a big date coming up ahead of us. August 1st is the deadline, the revised deadline for the deals to be struck with the US government. And right now, Canada does not have a deal in place. And so August 1st is right around the corner. And that could cause, another short term impact. But, the way these things have played out, calm heads prevail over time. It's just in the short term, things can get a bit erratic.
There was an expression in the business years and years ago, sell in May and go away, because the Wall Street and Bay Street are just deserted these days. Was that something you used to do?
No, that's a terrible, 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 terrible advice. Um, I mean, selling at any point in time usually doesn't make sense. Traders might like to say that, but traders are not the same thing as investors. Investors should have a long term view, and selling at any point is probably a bad idea because you're not following your long term strategy. I came up with my own phrase, Pat, and I had to write it down, so I have to read it. So I said, stop looking at your account balances in May and keep it that way. So don't let short-term impacts or other, current events affect the way you think about your investments. So if I get famous because that phrase was mentioned and I get credit for it, it's good for you too because it was on your podcast.
Okay, there we go. We'll put it out on TikTok or some other place. Okay, so we did mention earnings and the Magnificent Seven, the techs, Microsoft earnings came in staggering numbers. So I get what's happening with the Magnificent Seven. But you mentioned earlier that international markets, global markets are doing well. Why is that?
Well, no economy operates in a vacuum. Even though there's kind of some trade issues at the moment, the world is a globally integrated economy. So it makes sense, when the United States is doing well, and the United States is the largest economy in the world. When it's doing well, others should do well as well. It's just there's high correlation. When things do poorly, everybody does poorly. So that's that over time, as more information gets disseminated, as technology enables trade, transactions, electronic commerce. All of these things are so integrated that it's inevitable when when things are clicking on all cylinders, everyone is going to benefit, and their stock market should reflect that.
Let's take a look at fixed income and the world of interest rates. Let's start with Jay Powell because Trump, as you pointed out, is an unknown, and he brought in Jay Powell, but he looks like he wants to send him out as well. What is your thought on how that's affecting the markets?
Well, yeah, unconventional, unprofessional might actually be the way that Donald Trump has handled Jay Powell. Tweeting out that he's uh, too late, too slow, too stupid, a total loser. He's used all of those words in capital letters too to describe Jay Powell, and it's shocking that even though the Fed has a mandate of independence, it drives the president crazy because he wants to control everything. And right now they're at odds with one another because Trump wants lower rates because that's good for the economy. But the Fed has a responsibility to keep stable prices. And we had the inflation scare, a little over 2 years ago, and it still has not been tamed. Inflation is still pretty warm, not as hot as it was. I think we've gotten rid of the doom associated with rampant inflation, but it's still more aggressive than what the Fed would be comfortable with. Their target rate is 2%. We have not even come close to getting down to 2%. So they should continue to maintain rates at elevated levels until it comes down to that point. And there is no sign that the economy is deteriorating in the United States. So there's really no argument for the Fed to lower rates, even though the president is pounding on their heads, telling them to do so. In
Yeah, and then
Canada,
when
it's a
you,
little different.
sorry.
Yeah, I mean, it's we do have a weaker economy, but everything is just still so uncertain because we don't know the full impact of the tariffs yet, or even where the tariff positions are going to settle. So as long as people are uncertain, they're going to want to wait to see evidence to suggest they should move one direction or the other. But until that comes through in the data, which might not be for another quarter or two, the central banks aren't going to do anything, and they haven't done anything since March.
It's interesting. Against that background and the pressure from the president to lower interest rates, at least in the United States, you've got bond yields rising. And they say that the bond market is a better forecaster of the economy and of inflation, those kinds of things. What are your thoughts about the bond market? And then how does that adjust or does it adjust your approach?
Yeah, the bond market is definitely perceived to be the smarter. Uh, and I'm not sure if that's because they're more dependent on economic data than equity-based companies, because equity is more about speculation on success of products or things like that. Bonds are more boring. They pay interest. So it's not quite a fair comparison. Equities naturally are more speculative. Bonds are more, let's call it logical or more mathematical. So I could see the perception that bond market is perceived to be smarter. Um, Anyways, we don't really get too affected by. I mean, the Fed's going to do what the Fed has to do. Their ability to control the short-term interest rates affect the bond market. It's all based on their expectations of what they think interest rates are going to do at 5-year maturities and 10-year maturities and 20-year. That's a lot of years into the future to try and speculate on where things are going to go, and it can change so quickly. If we look at where interest rates were 4 years ago, they're nowhere near where they are right now. And of course, nobody predicted that. So there's no sense trying to speculate and move around because the market is fickle. The market always adjusts, it always reacts. We plan for the long term, and over long periods of time, things are pretty stable. The impact of moving interest rates or even sharp moves in the stock markets, they all tend to even out. So having the long-term view really helps tune out any type of short-term impacts that you get from the bond market or the equity market.
So, as a summary, for the general public, so not everybody's invested, how would you approach the markets right now?
No differently. So our advice, I mean, it does not change. Individuals that are investing in the market for whatever purpose they are have in mind, focus on your time horizon, focus on your investment objective, whether you need income, whether you're trying to preserve capital, or whether you're trying to grow your capital. Understand what that objective is and know your realistic comfort with risk. Don't take more risk than you're comfortable with, because you're going to come to regret it at some point. When you can lock down those three things, you can identify what your perfect investment strategy should be, and then you just stick to it. It doesn't matter whether markets are at an all-time high or if they're at a trough. The advice does not change.
James, always a pleasure to speak to you. I'll see you in a couple months.
Okay, sounds good, Pat. Thanks.
James Gauthier, Chief Investment Officer, Justwealth.